Hello and welcome to the latest Nomura podcast, Goldilocks versus the Bears. My name's Andy Chater, Fixed Income Product Manager here at Nomura. We're talking today because there seem to be two schools of thought in the market right now. One that says we are in a Goldilocks scenario with reasonable growth but little inflationary pressures. Another school of thought that says risks are building up in asset markets and there are some risk events on the horizon that should make us cautious. To try and guide us through these propositions and see where the truth lies, I'm delighted to be joined by Bilal Hafiz, Head of G10 Rates and FX Strategy, and Andy Cates, Head of G10 Economics. Andy, maybe let's start with you. Your view is that the Goldilocks scenario remains on track. What are you looking at to give you confidence on this?
Yeah, thanks, Andy. So I think there are three features of the world economy at the moment that speak pretty favourably about the outlook from here. The first is that we're seeing a pretty strong, pretty synchronized global growth recovery at the moment. There's very little evidence in any of the forward-looking data flow that suggests that that strength is likely to fade in any meaningful way in the coming months. Importantly as well, that current burst of growth is being led by developed economies and by capital spending growth within those economies in particular. And I'd emphasise the latter as being pretty important because it suggests that this phase of strength has far more self-sustaining elements behind it, certainly relative to previous recoveries that we've seen over the last few years. The second feature that I'd underscore it concerns inflation and inflation expectations, which are very well anchored. They're still at very low levels, and in many cases they're below the comfort zones of central banks. And that means that those central banks obviously have no need whatsoever to squeeze inflation out of their system. It means that monetary policy will remain very accommodative. The stock of assets on central banks' balance sheets is going to keep rising for some time. And notwithstanding some likely rate hikes from the Fed, that's obviously going to keep offering support to global financial conditions. The final feature that I stress concerns the advanced stage of balance sheet repair in many major economies, including in the public sector. That means there are no glaring financial imbalances in those economies, and it also means there's a lot more scope for fiscal policy to add support to global growth, even in the period ahead. And so all of this obviously speaks pretty favourably to the global growth outlook. Now, all of that aside, I'll just end with one point here, which is that global growth expectations are undeniably quite high at the moment. We've seen a string of positive data surprises over the last few months. I don't think it would be that surprising if we see a softer patch of data, at least in the immediate weeks ahead, at least relative to high expectations.
Okay, thank you, Andy. Bilal, let's move on to you because you've highlighted in a couple of recent notes that there are some risks building in the system. What is it in particular that's concerning you right now?
Yeah, I mean, I guess from my side, the way I would look at things is how do markets respond to economic fundamentals? And I would say that markets tend not to just look at where growth, what the level of growth currently is. Instead, what it focuses much more on is how our growth outturn is going to be relative to current expectations. So what matters for markets is, what is it currently expecting and what's the balance of risk around that. And then the other thing is what I think also matters is the momentum in growth. So not only is growth higher, but is it higher than the previous year? So those two dimensions I think are very important for the trajectory in risk markets. And on that basis, my concern right now is that if you look at credit markets, if you, for example, look at the crossover spread, so high yield credit default swaps in the euro area, it's at its lowest levels in its entire history. If you look at US high yield markets, their spreads are at the lowest level since the financial crisis, 2008. There was a brief period it was lower in 2007. If you look at equity markets, if you look at the 12-month returns adjusted for volatility, over the last 12 months, US equity markets and world equity markets are experiencing their highest ever, save one period of 12-month returns. Only in 1995 did the US see higher risk-adjusted returns in stock markets than they did today. And that back then, you had an environment where the US was coming out of the Mexico crisis. The Fed cut rates in 1995, and it was the beginning of the dot-com boom. And so my concern is that these incredibly elevated levels, I just think that there are some risks to these expectations. And more immediately in the next month or two, I think that if you look at data surprise indices in the developed world, they're at very high levels. So I think there's scope of disappointment on the economic side. On the absolute level, I think post-plenum, China is signaling that it's going to pick up its deleveraging, and some of its recent data has been weak. So I think that's likely to permeate markets. And then we have a Fed hike that's likely to occur in December, which typically when the Fed does start a mini phase of hikes, the risk markets tend to sell off. It's been a fairly robust relationship over the past 20 years. And then we also have a number of event risks, whether it's US tax risk, government shutdown risk in the US, special elections, Brexit negotiations, Catalan elections. All of this comes in December, which is typically a poor period for market liquidity. So all of these together, I think, makes me nervous for the next month or two. And that's part of the reason why I'm more in the bearish camp right now.
Okay, so Andy, maybe turn that over to you. Bilal's highlighting some good reasons to expect asset markets priced for perfection might have some wobbles. Can the key developed market economies deal with it if there is an asset market wobble?
Yeah, I think they can. And let me stress, I don't think that the degree of disagreement between us is actually that large. Valuations are high, markets are pricing in a Goldilocks situation. They're pricing in a lot of growth. They're obviously pricing in no major policy accidents. They're pricing in no major destabilizing forces. I think perhaps where we might differ a little is whether, or shall I say, that the likely time frame over which this risk-off phase might last and the degree of damage that it might generate for the world economy. Bilal certainly makes a very good point on China, and I would stress that for me that's probably the biggest risk, the biggest unknown right now. But I would suggest there that again, just like there's no need for policymakers to, shall we say, throw cold water over any overheating pressures, there's no need either for China's policymakers to destabilize their economy. I'd additionally point out that as far as China is concerned, there has been some decoupling between the growth rate in that economy and growth rates elsewhere. China's economy has been negatively surprising for some time. Developed economies have been shrugging that off. And that goes back to the kind of domestic demand autonomy that we're seeing in those economies, combined with, actually, I think, what appears to be a bit more resonance coming through from some other Asian economies, such as India, such as Indonesia, that has some scope for positive surprises going forward. So, to repeat, I don't disagree in the idea that we're going through a soft patch in the macro, and we're likely to see some negative data surprises in the period immediately ahead. Whether the cycle, though, will move down with force, with resonance, and meaningfully surprise on the downside, that's where I have my doubts.
Okay, maybe last question for you, Bilal. Given your concerns about potential risk market wobble in the near term, what sort of key event or indicator would you suggest that Nomura's clients look at to give them some warning of that?
Yeah, I mean, I think one has to look at a range of different markets here. I think one should look very closely at what's happening in China. So one would look at measures that indicate they are trying to tighten liquidity conditions. So looking at Chinese interest rates are important. Recently, 10-year Chinese bond yields almost touched 4%, which is a big increase since the plenum, which suggests that they are taking back some of that liquidity. So that's on China. I think elsewhere in the Euro area and the US and Japan, data, of course, is important. So the next run of PMI numbers will be important. But even perhaps more important than that is some of the event risks that we have. So we have a number of event risk, political events that we have to see how they unfold. Will tax reform in the US pass? The consensus at the moment is that it will, and the corporate tax cuts for sure will pass. That's what the consensus is. If there is delays in that, that should have a knock-on effect on risk markets. And the final thing I would say as we go into year-end is what you typically find into year-end is that liquidity conditions really start to tighten up. And there is a measure, something called cross-currency basis, which gives you a sense of how easy is it to obtain dollar liquidity in the market. That basis has been widening in recent weeks, and that's usually a signal to tell you that not all is well. as we go into the end of the year.
Perfect. Thank you very much. I mean, I think there is a clear message coming out from you gentlemen, which is markets are priced for perfection. There are some risk events that may well lead to an asset market, risk market correction over the near term, but that economies overall are in a strong footing. Indeed, perhaps could go as far as to say that any risk market correction around the turn of the year could well be an opportunity for investors as we head into 2018. I think we'll leave it there. I'd like to thank Bilal and Andy both for joining me and hope that you can join us for our next podcast. Thanks very much.